With mortgage rates approaching 7%, is it a good idea to still rent?
This should be interesting.
We're going to tackle that question today. My name is Jimmy Roberts, and we actually have to answer 3 different questions first. The first question is this. 1, historically, what are interest rates been? We're used to the really low interest rates, but historically, over a long period of time, other than the last 5 years, what have they been? And once we figure that out, do we expect them to change very much going forward? That's question number 1. Question number 2, what about rental rates? Where have rental rates been? Are they historically high or are they historically low? And also, do we expect them to go up or down? And finally, the third question we have to ask is, what about home values? Are home values increasing in value? Yes, they are. And again, do we expect them to go up and down in the future? So we need to know all those answers so we can figure out the various risks, so we can judge them appropriately.
We'll just see how it shakes out.
So let's jump in to question number 1. Historically speaking, what have interest rates been? Well, here we go. Right now, interest rates are approaching 7%, as we know. The thing is, though, historically, as you can see by the chart, over the last 50 years, the average mortgage rate was right about 7.5%, maybe even a little bit more, maybe like 7.7% for a 30-year fixed mortgage. Now think about that, 7.7% for a 30% fixed mortgage. And that was the average. That means that it was significantly higher at one point and significantly lower. We're very familiar with the lower part.
Yeah, basically.
Now, the problem that we're dealing with here is a problem of perception and perspective. So if you are newer to the market, say within the last 10 years or so, you don't know anything other than a mortgage rate in the less than 5%. But that is really an anomaly, and it's something that the Fed has been doing to keep growth in the economy going. Now, that sounds like a good idea, but there's some problems with that.
I've got to be kidding me.
1, by making money really cheap, you do encourage businesses to borrow money so that they can expand their businesses. That's better for the economy. Great. That's one good thing. But 2, the other part is it makes home purchases a lot better and easier and cheaper for people to purchase homes. And I personally think buying it for people owning homes, I think that's a good thing. But there's some bad parts about it too. 1, and this is probably the biggest one that gets us in the most trouble, by having money be so cheap, and 1% interest rates are cheap. That's cheap money. By having interest rates be so low, what that means is that also allows for a lot of speculation. And speculation, a little bit is good, but let's be honest, we've had a lot. Because of speculation, we've had, you remember the internet bubble? Pop. What about the housing bubble? Pop. And the housing bubble, because it's tied to so many other things, also led to the recession that we all have gone through back in 2005 to 2010, depending on when you started counting, right? So those are the direct effects of having a lot of loosey-goosey capital in the system. That is what happens, okay?
You are scaring me.
So interest rates rising, while it hurts, it sucks. Let's call it what it is. It really does suck. But in a broader perspective, it's probably a good thing, right? Because again, one of the things that we suffer from today is very high inflation. Here's an example. Last year, when you went to go buy a gallon of milk, it cost about $2. This year, you went to go buy that same gallon of milk and it was $3. It's a year and it's the same gallon of milk. What changed? Inflation. That's what changed. There's so many more dollars available in the market, prices just go up. You've seen the same thing in the housing market. See? So, inflation is not a good thing, right? It's not a good thing, and we can offset some of that by rising interest rates. Now, here's the next part of that question. Do I believe that interest rates are going to continue to go up? Personally, I think they'll go up a little bit higher, maybe 7.5-ish range, but I think they're probably going to settle back down when everything's all said and done. Over the next few months or so, they're going to settle back down in that 6.5 to 7% range. I think that's going to be about where we're going to be. So 7%. Now, here's the thing. 7% is actually a very good rate. It is. I mean, it is.
Really?
You can buy a lot of house at a 7% interest rate. So just remember that. So now let's jump into that next question. Rental rates. So here we go. So rental rates are interesting, right? Because we all know that rental rates have increased significantly over these last 2 years in particular. I mean, we see just some huge, ridiculous increases. Now, if you were a landlord, that's amazing. If you're a renter, it absolutely sucked.
The problem with us is we're always renters. We're never the landlord. We're never the owner.
But either way, we've seen some huge increases. Now, let me give you a few statistics to help you give you a little bit of perspective. First off, nearly 35% of all U.S. households rent. Think about that. 35% of all U.S. households rent. And since 1934 was the last time there had rental rates, the percent change in rental rates was negative. Okay, so what does that mean? It's been since 1934 since rental rates actually went down year over year. That means that if you're paying $1,200 now for your rent, chances are next year you're going to be paying more.
But we don't have the money.
Best case scenario, you'll be paying the same $1,200, but you're not going to be paying $1,100. That's just not going to happen, right?
My mama's so poor she wears around a popsicle and calls it air conditioning.
So that's an important thing to consider. So will rental rates continue to increase? Yes, they will. They will continue to increase. Will they increase at the same rate that they're increasing at now? Probably not. Probably not. In my opinion, I don't think that's sustainable. Just like the housing prices going up as fast as they are, or fast as they were. Same thing with rental rates. I just don't see that. And this is the third question. Single family housing. Historically speaking, what's going on with single family housing? Now, I'd like to think of it as a couple of different areas. Now, if you can take a look at the graph, you're going to see that over this last 2 years, from 2020 to 2022, there has been a significant explosion of home values. Right after COVID, or right during COVID to October 2022, home values have increased by nearly 41% year over year from a national standpoint. Nationally speaking, the average home price for an average typical house is nearly $455,000 for an average property. Think about that. That is huge.
This is getting really expensive.
And that is off of an explosion of over 41% in the last 2 years. Now, why do I keep pointing out that 41%? I keep pointing out that 41% because the last time we've seen a 40% growth in home values, it occurred between 2010 and 2020. So it took 10 years to increase 46%. And in the last 2 years, we've increased by 40%. That's unsustainable. That is completely unsustainable. So basically, what we're saying is if we're looking at from 2010 to 2020 as average, as a realistic viewpoint, that averaged about 4.5% per year. 4.5% per year is realistic, in my opinion, especially when you consider that in real estate, we consider anything plus or minus 3% to be stable. So we consider the local market to be stable if home prices increase or decrease approximately 3% per year, if it's within that range. So if you're at 4.5%, you're a little bit over the 3%, and you're seeing a nice slight increase, right? Nice and easy.
Easy.
It's easy money in the bank. It's nothing ridiculous. That is wonderful. Again, that is absolutely wonderful. The gains that we've seen from 2020 to 2022, that can't be sustainable. As a matter of fact, I know it's not sustainable because that's why the Fed stepped in and increased interest rates. In January of this year, 2022, typical interest rates were right about 1.5%, 2%. Today, right now in December, we're approaching 7%. That is a lot of interest rates increases over a very short period of time. So needless to say, we're not going to see that continuing rocket in home values. So that's not going to happen. Will home values continue to grow up? Absolutely. And here's why. Home value is going to continue to go up because we still don't have enough supply. There's still a heck of a lot of demand, and we just don't have the supply.
Nothing.
We haven't had the supply since the last housing boom. Just the way that it is. Okay, so question number one, do we expect interest rates to stabilize? Yes, they will stabilize probably around 7.5% in my opinion. Do we expect rents to decrease? No, rents will not decrease. They will go up. They may not go up as sharply, but they will continue to go up. And three, this is the big one, home values. Will home values continue to rise at the same rate that they're rising? No, they won't rise at the same rate that they're rising at over these last 2-year period, but they will continue to rise. So with the answer to those three questions, I've got to say, it really depends. Since interest rates are approaching 7%, should somebody still rent? It really depends. And here's why it depends. It depends on where you live. I'll give you an example. Property investors, specifically real estate investors, really don't know how to value property. They don't. They just simply do not know how to value property the way banks do. Hey folks, how you guys doing today? Jimmy Roberts here. And after 30 years in the real estate business, over 20 years of that being in the appraisal business, the one thing that I know is for sure, the 5 biggest mistakes that real estate investors make that keep them from making big profits on their flips and in their investments in general. And I'm making that available to you. All you have to do is click the link below, and there you go. I live in Michigan, and here in Michigan, one of our major cities is the city of Detroit, city I grew up in. Now, the city of Detroit has a zip code in it, 48221. 48221 is an amazing area. It's got some houses that are absolutely gorgeous. That's where all the superstars and stuff live. All the doctors, lawyers, and attorneys, judges, and all those people, they live in this zip code, as well as average folk live in this zip code. I mean, when I say average, I mean people who, they go to work every day. They do the business of society. They have jobs. They raise kids, and they just do the stuff, right? Both are in this zip code. So it's a good microcosm for the city in general. Now, the average sales price of homes in this zip code, according to MLS data that I just looked at, is $170,500. So $170,500 will get you an average house. Now, I'm saying that's going to be an average house. It's not going to be the Big Mac Daddy mansion. It's not going to be a shack. It's going to be an average house. 3 bedrooms, 1.5 baths, living room, dining room, probably a family room or something like that. All right? Average house. Now, here's the thing, and let's talk about some numbers here. If you assume, since $170,000 qualifies well for an FHA mortgage. So an FHA mortgage requires a 3% down payment. I think it's 3.5, but for our example, we're going to go with 3%. If it's a 3% down payment for a $170,000 house, you're looking at a approximately $5,000 down payment. That could be donated to you by the seller. So perfect situation here. All right. So here we go. So you got a mortgage for about $165,000. In my calculation, I think I calculated it to be $165,500. That'll be your mortgage. Let's use that 7% interest rate. So we have 7% as the interest, 360 months is the end, or 30 years, and a mortgage amount of $165,500. Perfect. That gives you a payment for principal and interest alone of about $1,100. Okay, so a monthly mortgage payment on $165,500 is the monthly payment for principal and interest alone is about $1,100. Now you figure you still got to pay taxes and you still got to pay insurance. Now, houses in Detroit, now I could be a little bit more controversial, but I'm not. We're going to say that the taxes and insurance are going to be approximately an additional $300 a month. So for our purposes, you're looking at a complete principal, interest, taxes and insurance, PITI, of $1,400, roughly. Now, $1,400 is a lot of money. It is. I know it is.
That's a lot, right?
That said, ask me what the rental amount for a 3-bedroom, 1-bathroom house in this zip code is. Go ahead, I'll wait. Go ahead. Come on, ask me.
How much money exactly?
How much does it cost?
Okay, the average or the rental range, according to GoSection8.com, which means that it's going to be subsidized with Section 8 housing, which means that this may or may not, this is not necessarily market. Market is actually going to be a little bit higher, but for our purposes, this example is going to work. For homes in this zip code, you're looking at between $1,200 and $1,500 per month for rent. $1,200 to $1,500 of subsidized rent. Now, again, in this market, that is the subsidized rent is $1,200 to $1,500, but you can expect to pay 5 to 10% more for non-subsidized rent. So that means that if you are not being subsidized by the government for whatever, you can expect to pay, as opposed to $1,200, you can expect to be maybe $1,250 to $1,600 for the same house. So there you go. So for our example, though, let's take an average and let's just say it's $1,350. So if the rental payment for this house is $1,350, that means that for $1,350, you get to live in this house for 12 months, right? Perfect. Everybody's happy. Well, we just calculated that the principal, interest, taxes, and insurance, if you bought this same house or a house similar to it, was $1,400. So right on its face, you're probably saying, well, rent is cheaper than buying a property. Yes and no. But right off the rip, you would be absolutely correct. But one of the things that I have to tell you is this. As I said earlier, rents in the United States have never decreased since 1934. That means your $1,350 that you're paying this year, next year is going to be $1,400 at least. That assumes, and the $1,400 assumes a 3% rate increase, just 3%. Now, I told you before, 3% increase, plus or decrease, is considered stable. If the market remains stable, meaning it doesn't increase, it doesn't decrease significantly, a 3% increase is normal. That's what you can expect. You can bank on it, at least 3%. So that $1,350 again goes to, actually it's like $1,390, but if you're a lazy landlord like me, that means $1,400. From $1,350 to $1,400. That means that that's what you'll be on the hook for every month, $1,400, which is, by the way, the exact same amount that you would have been paying if you purchased the property. But there's more. If you purchased the property a year before, when you came around to that second year, the same time that your other friend who decided to rent would have been experiencing their rental increase, you also get an additional benefit. Because you paid interest, mortgage interest on your home for an entire 12 months, you get to get a tax deduction for your mortgage interest. In this particular case, it comes to about $11,500. Now, why is that important? That means that $11,500 you get to not pay taxes on. That means that if you make $50,000 as doing whatever you're doing, now you get to reduce that amount that you pay taxes on by $11,500 and you pay taxes on the rest. Your friend over here still has to pay taxes on the entire $50,000.
Come on. Come on, my friend.
That is just one benefit of being a homeowner, even with a 7% interest rate. Now, in this situation, it works out because, again, housing values in Michigan, while they have increased significantly over recent times, are still relatively low compared to other parts of the country. I don't know that this would work so well if you were in, say, California, where the average home price is probably closer to $750,000 to $1 million. The math just don't math in those situations. It may be better to rent out there because I don't see anybody spending $5,000, $6,000 on rent, but they'll probably charge you a good solid $2,500, $2,000 to $2,500, which is still significantly cheaper than it would be if you were purchasing the property.
I say amen to that.
Significantly cheaper. So, the math just doesn't work in those types of situations. But then again, I'm not in California, so I don't know. So I can tell you about Michigan and the Midwest states for certain. California is its own animal. So I guess that's the answer. Since interest rates are increasing or approaching 7%, is it a good time to rent, or is it a good time to still remain renting? And I would dare say in probably most markets, no, you should buy.
I can't prepare on that.
But there are certain high value markets where renting still makes sense. Now, another question that you might ask though is, even if I decided to buy a home, well, I still got to find a home to buy, because that is still an issue. As I told you earlier, that is the issue. That's why we're going to still see increasing home prices, because our supply is gone. And if you want to find out why, check out this video. See you later.